China and Russia have just slammed the door shut on the US dollar completely. This isn't a theory or a future plan, it's happening now. Oil, minerals, and microchips are being traded in rubles and yuan. Meanwhile, Washington is demanding that China open its markets. But American exporters are already bleeding. Small businesses are folding. And across Asia, central banks are sitting on a $2.5 trillion time bomb, ready to explode. Trump believes tariffs give him power. But what if they're actually a weapon aimed at our own economy? Stick around. Wall Street just felt the shock, and your job might be the next domino to fall. How do you expect someone to invite you into their house while you're locking your own doors? That's the strange contradiction at the heart of Trump's latest trade moves. While Washington demands wider access for American companies in China, it's also enforcing a massive 145% tariff wall that's suffocating Chinese imports. This isn't just a theoretical issue. Based on May 2025 pricing data, importers now need to charge $18 just to break even on a $10 product. Scott Bassett argues that it's all about getting the best deal for America. But the US is asking China for big compromises while offering fewer of its own. Even though US exports to China still total more than $140 billion and support over 500,000 American jobs, this imbalance isn't improving, it's getting worse. And here's the odd part. If US leaders really think that access to China's consumers is essential, why are they making American products more expensive and less competitive abroad? That kind of contradiction doesn't just weaken America's bargaining power, it puts its own businesses on the back foot before talks even begin. At the ports of Los Angeles and Long Beach, shipments from Asia have dropped almost 40% compared to last year. But don't assume China is hurting just as badly. It's not. It's adapting. Trade data from April 2025 shows that while Chinese exports to the US fell by 20%, its total exports worldwide grew by 8.1% in dollar terms. China has simply rerouted its goods to Southeast Asia and Europe, both of which saw double-digit increases in imports. And this shift didn't happen overnight or by accident. It's the result of supply chain changes that began as early as 2023. The US thought tariffs would freeze Chinese factories, but China adjusted quickly, trading one major partner for a network of others. So, did the tariffs really put pressure on Beijing, or just shift the trade flows to friendlier markets? If China can reroute global shipping this quickly, then who's truly more dependent on whom? China hasn't responded with loud statements or flashy headlines. It simply slapped a 125% tariff on US goods and walked away. The outcome says it all. US shipments to China have plunged. American giants like Apple, McDonald's, and Starbucks are now watching their presence shrink in cities they once dominated. According to S&P data, American companies made over $1.2 trillion in revenue from operations in China last year. To put that in perspective, that's 4 times larger than the entire US trade deficit with China. But here's where it gets interesting. Chinese consumers are already beginning to shift their loyalty. Brands like Luckin Coffee are becoming serious competitors to Starbucks in major Chinese cities, especially in Tier 1 hubs like Shanghai and Beijing. On the tech front, Huawei is gradually regaining ground, eating into iPhone market share bit by bit. This isn't just about competition anymore. If these trends continue, American brands won't just face falling revenues, they could face outright irrelevance in the world's second-largest economy. So here's the real pressure point. Can US exporters survive this slow freeze in China's market? Or is Beijing methodically and quietly closing off one of the most valuable markets for American businesses? This is where everything shifts. Pause and think, because this could be the moment that changes everything. In Washington, the White House has pointed to plummeting container traffic between the two countries as a strategic success. They claim it's a carefully planned supply squeeze, a form of economic pressure aimed at making Beijing bend. But what if it's not pressure? What if it's actually a sign that the US is doing serious damage to itself? Back in May 2025, a meeting took place in Switzerland between US Treasury Secretary Besant and Chinese officials. Former President Trump described it as a very good meeting, raising hopes of progress, but no agreements came from it, no frameworks, no official announcements, just silence. Meanwhile, back home in the US, small businesses are starting to feel the burn. Companies like Same Company in Massachusetts, along with local florists in Kentucky, are reporting delayed shipments, sudden cancellations, and soaring costs. For instance, WSAM reportedly lost $16 million in expected retail orders, and now has $500,000 worth of products stranded in Chinese ports. If the White House sees this as a tactical win, it's ignoring the warning lights on its own dashboard. Because when your supply chain is suffocating and your export-driven businesses are crashing, maybe it's not the other side that's flinching. Maybe it's you. This spring, a joint declaration between Russia and China made things even clearer. Their governments confirmed that their bilateral trade is now almost fully conducted in yuan and rubles, not US dollars. This includes vital resources like oil, natural gas, metals, and industrial components. According to both countries, the purpose of this shift was to create a system that could function independently of third-country interference. That's a polite way of saying immune to US sanctions and dollar pressure. As of April 2025, more than 50% of China's total trade is being settled in non-dollar currencies. And the data backs it up. SWIFT, the international payment network, shows that yuan usage in cross-border transactions has jumped from just 2% in 2021 to over 4.3% in the first quarter of 2025. But here's the deeper issue. It's not just about payment systems. It's about trust. A currency only holds global power as long as people trust and use it. And right now, China and Russia are building parallel financial systems that don't need the US dollar at all. So the question becomes, who's going to join them next? A financial time bomb may already be ticking beneath the US dollar, and the fuse might be shorter than anyone thought. Economist Stephen Jen recently revealed that exporters from China, Taiwan, Vietnam, and Malaysia have quietly built up more than $2.5 trillion in dollar reserves since 2020. But that reserve pool is now extremely fragile. After a round of US-Taiwan trade talks, the Taiwan dollar surged 8% in just 48 hours, its biggest spike since 2007. That move triggered a chain reaction across Asia, where other currencies started strengthening in tandem. At the same time, the ICE US dollar index, a key indicator of the dollar's global value, fell by 9% in 2025 alone. Traders are now preparing for what Jen describes as a non-linear sell-off. That's when multiple countries decide to dump their dollar holdings at once, not because they want to, but because they don't want to be the last one stuck holding a rapidly weakening asset. But don't mistake this for just market noise. This is a structural shift in the global financial system. The U.S. Federal Reserve is expected to cut rates by 75 basis points this year. Meanwhile, dollar-based assets are considered overvalued by many analysts. That's a dangerous mix. Now, central banks across Asia are facing a very tough decision. Do they start selling off their dollar reserves slowly and quietly? Or do they wait and risk being crushed when everyone else rushes to the exit? Either way, the choices these countries make could end up redrawing the map of global finance. And as for the long-term consequences, they haven't even started to unfold yet. In Massachusetts, W.S. Gameco had $500,000 worth of merchandise stuck in Chinese ports, and then lost $16 million in U.S. retail contracts in just one quarter. Over in Oklahoma, 4K9 saw Tariffs crush its ability to bring in dog seat covers, even as demand surged. In Michigan, Lisa McDonald's tea house, which relies on premium leaves from China, says she's only weeks away from being priced out of her own market. These examples span different sectors, but they all echo the same message. Help isn't coming. These aren't massive corporations with global safety nets. They're lean, hard-working American businesses getting steamrolled by a policy machine that won't even take their calls. Trump's tariff policy is hitting smaller firms the hardest. Unlike multinational giants with flexible global supply chains, local businesses can't simply rewire sourcing strategies that took decades to build. And while officials like Besant claim the U.S. remains the top spot for global investment, small businesses are shutting down before that investment ever reaches them. So, what happens when the very economy Washington is trying to shield can't survive the protection? Even if a new deal is made, the tariffs won't disappear. According to White House trade advisors and direct remarks from Besant at the Milan Institute, Trump is pushing for a permanent 10% baseline tariff on all imports, including those from allies. That structure doesn't just punish adversaries, it builds added cost into the entire U.S. supply chain. The Kiel Institute estimates this approach will slash U.S. exports by 17%, with American producers either eating the cost or losing market share abroad. In comparison, China and its partners expect just a 5% drop in exports. easily absorbed thanks to lower operating costs and slimmer margins. In short, the nation pushing hardest for global trade changes is also making its goods the least competitive. And now that tariffs are baked into nearly everything, manufacturing parts, finished products, even consumer goods, the very sectors meant to be protected are slowly being pushed out of the global market. But maybe this isn't about economics anymore. Maybe it's about showing strength, no matter the cost. If China pulls back, Wall Street might follow, and the dollar could take a hit. If Chinese buyers stop purchasing American goods, the impact will be fast and honestly pretty painful. In 2024 alone, the United States exported over $140 billion in goods and $46 billion in services to China, supporting close to 900,000 U.S. jobs. California alone exports $15 billion to China each year, while Texas sends over $21 billion. But the greater danger isn't just to trade, it's to the markets themselves. According to S&P Global, U.S. companies generate about 7% of their yearly revenue from China. If that revenue disappears, so do company forecasts, dividends, and, well, investor trust. And when Wall Street suffers, the dollar stumbles. Global demand for U.S. stocks and bonds is driven by trust in steady growth. Take away China's consumer base, and you don't just miss earnings targets, you shake the entire financial system. Investors won't wait for press releases. They pull out at the first whiff of instability. So here's the real question. Can the United States keep the dollar strong while forcing its top trading partner to walk away? This isn't just a tariff fight anymore. It's the slow undoing of the global trade model built after the 1990s. The data makes it clear. We've passed the point of no return. China has rerouted its exports, loosened currency ties to the dollar, and invested heavily in yuan-based trade settlements. Russia has cut out the dollar altogether. Asian exporters are bracing for a post-dollar world. And while Washington claims American markets are still open, its tariff stance sends the opposite message. Small businesses are crumbling, Wall Street is vulnerable, and the dollar is showing cracks under the pressure of tough-looking policies that may actually be structurally weak. So think about it. If the dollar no longer holds the world's trade together, does the United States still hold global power? And what happens to every business, loan, and retirement fund that's built on the belief that the dollar will always win? Thanks for watching. If you found this video valuable, please like, subscribe, and check out our next one. It's up now on your screen.